Hello everyone. Today our group will explain IL&FS default of 2018 and how it lead to cognition of India's NBFC funding market. IL&FS, Infrastructure Leasing and Financial Services, was largest Indian NBFC that financed long-term projects such as road construction, power and port construction. Until the mid of 2018, IL&FS has a credit rating of AAA and it raised fund through commercial paper, bond and long-term loans from bank. At the time of default, IL&FS has an outstanding debt of 91,000 crore, which was spread systematically around bank, mutual fund, and insurance company. In September 2018, IL&FS default on short-term borrowings like commercial paper, shocking the entire market. A default by AAA-rated NBFC caused panic across the entire sector.
Hello everyone, my name is Rashti Koshe and now let's cover credit risk and probability of default part. So credit risk is the risk that a borrower may fail to repay its debt and PD, that is probability of default, measures how likely that default is. Now as we all know, before 2018 IL&FS was rated AAA, which implies an extremely low probability of default. Because of this, banks, mutual funds, basically all the investors considered IL&FS very safe and continued lending to it easily. Non-papers, IL&FS appeared low risk due to strong financial ratios, long-term infrastructure assets, and government-linked shareholders. However, the real risk was hidden. That is, IL&FS operated through 169 special purpose vehicles. So now, what is SPVs? SPV is separate legal company created for a specific project where loans and cash flows are isolated from the parent firm. So these SPVs were highly leveraged and had delayed cash flows and reduced transparency, making the group's true risk difficult to assess for the investors. Now, as a result, the reported PD looked low, but the actual economic risk was much higher. The core problem was asset liability mismatch as IL&FS borrowed short-term funds, short-term securities, but invested in long-term infrastructure projects. So this meant repayment were due before cash inflows arrived, creating sudden liquidity stress. So despite a low reported PD, the true probability of default was significantly higher, which ultimately led to the collapse.
Concept 2, which is rating actions. I will explain this using the visual on the screen. Please look at this the screen. How IL&FS defaulted turn into an NBFC contagion. So let's understand this step by step. First, IL&FS was borrowing short-term money, for example, for 3 to 6 months, but investing that money into long-term infrastructure projects like roads and power plants. This created a maturity mismatch because projects were not generating cash quickly, and now many of these projects were also housed in SPVs or special purpose vehicles. When these SPVs started facing cash flow stress, they couldn't send money back to the parent company on time. As a result, in September 2018, IL&FS missed a short-term payment. This is where rating comes into play. So before just a second. Yeah. This is where ratings come into play. Before the default rating, agencies had given IL&FS up AAA rating, which signals extremely low risk. But once the payment was missed, ratings were downgraded sharply from AAA to junk within weeks. This sudden downgrade triggered a chain reaction. First, the debt mutual fund were forced to sell the IL&FS and other NBFC bonds because many funds are not allowed to hold low-rated securities. Second, this led to a complete freeze in funding for NBFCs. Lenders became nervous and interest rates shot up. Eventually, even healthy NBFCs found it difficult to raise money. And this situation created what we call a liquid debt spiral. Downgrades reduced access to funding, and lack of funding caused even more financial stress, leading to further downgrades. This crisis also exposed a serious governance failure within IL&FS. Weak, there was a weak broad oversight, a very complex group and SPV structure, and poor transparency about actual cash flows. So one key takeaway from here is that rating agency were reactive, not proactive, and they downgraded only after default occurred, and this delayed the recognition, magnified the shock across the entire NBFC sector. So what started as a problem in one company quickly turned into a system-wide liquid crisis. Thank you.
IL&FS default does not remain limited to only one firm. It could be spreads across the financial system. After IL&FS missed the short-term payment in September 2018, investor confidence collapsed. After that, mutual fund investor redeem their unit, forcing fund to sell NBFC bond and commercial paper at first at the fire sale price. As a result, eventually, healthy NBFC suddenly lost access to the short-term funding. Borrowing cost rose sharply, and the funding market froze. And the credit slowed down. Housing, auto, and MSME sector. NBFC were hit harder than the banks because they depend on market-based funding, unlike banks who have stable income of deposits. So, to contain the systematic risk, the government took control of the infrastructure leasing and financial service, while the Reserve Bank of India tightened the NBFC liquid norms and asset liability monitoring. In conclusion, the IL&FS crisis shows how mispriced credit risk, asset liability mismatch, weak governance, and delayed rating actions can turn the small default into a system-wide risk. Strong transparency and prudent funding structures are essential for the financial stability. Thank you.